Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Welcome to another Wealth Coffee Chat. Marvellous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong live for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well.
Morning, team. Hope everyone's doing super well out there. Andy Fenton taking care of the slot for Mr. Jason Witten while he is off rock climbing, doing some amazing things, an amazing character, doing amazing things in amazing parts of the world. A bit of an inspiration. Kevin, good morning from Florida. Morning, Kevin, mate. Great to have you on board. Well, while a few of you log in this morning, my name's Andy Fenton, coming in from down in cold Victoria, not the sunny coast where Witten's from. G'day, James. Hope you're well. Hope you're warm. And down on the Mornington Peninsula, where it is freezing cold at the moment, it's winter. We love it down here because winter is the time when we get all of the work done. If I was living on the Gold Coast in the warmer territory, I reckon I'd find it hard to get motivated during winter. So it's head down, bum up, and then enjoy the summer. Morning, Luke. Hope you're doing super well. So what are we going to talk about today? Well, I thought that I'd start to let you guys in on one of the next big things that we're going to be focusing on as far as our strategic development and the things that we're looking at in order to be able to hack the system a little bit and provide you guys with strategies that you'll be able to utilize within your portfolios, whether it be property, whether it be shares, wherever it sits. Morning, James. Morning, Alex. Hope you guys are well. Warm in Townsville here. Yes, rub it in. Look, you don't get this pale through too much time in the sun. But, mate, I wish you well. I'm sure it's an amazing sunrise up there. Alex, good to see you. So, yeah, I thought I'd share with you one of the big things that we're focusing on because the landscape around there doesn't seem to be changing too much as far as the government's concerned. So we have to take a few things into our own initiative. Hey, just for those of you who are on this morning, some of you might have heard me talk about this. Maybe Witten's waxed lyrical about it. I know that we've been dancing on a couple of stages, getting all frustrated at times and motivated and getting into it. But who can tell me what the tax rates have changed to as at yesterday? Does anybody know what the highest marginal tax rate is now here in Australia? Whack it into the chat. Have a little bit of a play with me. Participate. Probably, Kevin, if you're in Florida, you don't care, which is understandable. But Kevin, the rules that I'm going to take you through to this morning apply equally for over in the US. You've just got to retrofit some of the strategies and some of the numbers, but ultimately the way of thinking about it is very much similar. So whack it in the chat, folks. What's the top marginal tax rate change to? As far as income is concerned. Nobody's got the number. It's a little bit too early. Perhaps you're on the way to work at the morning. This morning. Jeepers creepers, I've got to wake up. Well, team, seeing that it hasn't popped up in the chat, the current tax rate has moved from 180 to 200,000. 200,000. But the bigger question is, how long has it been since they moved the tax rate? Joe Tubbs says 190. There you go. Sorry, did I say 200? It was meant to be 200. It's 190,000. Correct, Joe. Gold star for you, Joe. Gold star for you, Rebecca. Thanks for watching. It has. It's moved up by $10,000, which is a bit of a joke where I'm sitting. Team, do you know that was actually brought in 2009? So 14 years ago, that top marginal tax rate came in. Hasn't moved. Has inflation moved? I'd say that inflation's moved a little bit over that period of time. I'd also say that, on average, it's been a lot more expensive to live out here. But ultimately, the government are keeping more of the slice of the pie just by doing nothing. What an incredible strategy. Imagine if you had strategies where all you had to do was nothing and you would get a bigger slice of the pie. And some of you might be saying, what the hell are you talking about, Fenton? It's too early in the morning for soapboxes. I won't stay on a soapbox, but it's important that you understand the context. Same things are happening over in the US, similar things happening over in Europe. And one of the things that I'm going to talk about today is just how to navigate that top marginal so that if you're investing over a lifetime, that you can minimize the impact on politicians doing nothing and making more money. But whack a Y in the chat for a yes, please, if you would like to earn more money by doing nothing. Just whack it in the chat, a little bit of a Y. If you don't, if you'd prefer to be working for it, whack an N in there. But this is ultimately important frame up for one of the big things that we're working on. Yes, please, says Bradley. 100%. I'm in. I've got my hand up. I'd like to do nothing and earn more and more money. Yes, Rebecca. Yes, please. If you listen to Witten and his team, they'll say, well, once you buy well, then just sit down and do nothing for 15 years. So I guess that's one thing that you guys can do. And, the property strategies are good at putting more of the money back into your pocket. But ultimately, team, we're going to talk about structures today. But it's a little bit of a reminder for those of you I know who have seen us talk about this a lot. I'm just going to reshare it just to make sure that you guys are aware of it and that you also change your conversations with your accountants. For those of you who don't know what I'm talking about, stay tuned. I'm going to give you a little bit of a matrix that you can use when you go to your accountant and have a little bit of a chat. And then at the end of it, I'm going to show you some of the things that we're thinking about as far as what are the next big things that we're going to focus on in order to try and keep more money in your pocket, help accelerate your wealth, and ultimately, well, legally steal the money back from the government. And I said legally, just for all of you. So let's have a little bit of a look. For all of you that are going and having a chat with your accountant over the next month, 2 months, whatever the time may be, there's a thing that we call in a couple of our networks with the exit plan with Jason and the team at Positive. We talk about something called the game of 30, which is personal super structures in that order. So whenever it comes to tax planning, this is a little bit of a matrix that we like to use. You don't have to use it. We think it's a pretty cool matrix. It makes it nice and easy to think about tax management. There's no right way to do it. There's a lot of wrong ways of doing it, and this isn't one of the wrong ways. So, team, whenever you go and chat with your accountant, whether you're a business owner, whether you're an investor, whatever the case, career professional, we take this little matrix. We draw a triangle on the middle of the page, and we sit down with our accountant, and we ask, well, how much tax are we going to pay this year? Those of you who know me well, the first answer to that question is no, go away, do better. And but this is a way that you can start to tactically think about how to allocate your scarce resources. All right, scarce resources being cash. Now, the one that I'm showing you today, this is for this current year, but of course, that this year is now gone and the tax rates have changed, and I'm going to take you through that as well. But ultimately, did you know that based on the current rules, up to 120. Well, I'll make that a little bit bigger so you can all see it. Up to $120,000 worth of taxable income. See if I can make that a little bit bigger. There we go. Whoa. There. Okay, there we go. So up to 120,000, that averages out at 26% tax. When you calculate all of the tax that you're going to pay, including Medicare levy, at $120,000 worth of taxable income, you're going to pay about 26% tax. That's a pretty ripping tax rate. The only tax rate that we can get in the world of structures that is less than that is, of course, superannuation. That's in accumulation mode, taxed at 15% and 10% on capital gains. And then, of course, that'd be good. Yep. And then in the world of pension, you can get up to $1.9 million, 100% tax-free if you satisfy the preservation rules and do it the right way. So $120,000 per person, average of 26% tax. Now, under the current rules, if you're at 180, that's 30% tax. So what other structures have a 30% tax rate? Well, superannuation is still cheaper as tax is concerned at 0 to 15%. Trading companies, 25%. And then we have bucket companies or investment companies that are 30%. Now, I'm sure Witten's probably talked about this a little bit with you, and so has the team. But this is a bit of a clue as to one of the next big things that we're going to be focusing on. But anyway, you should be looking between you and your partner, 180,000, or what's your marginal tax rate, all right? And then you can calculate what your average tax is. Now, if you don't know how to calculate it and you're in the middle, there's simple resources that you can find online. This is TaxCalc, I think .com.au, but just type in TaxCalc into Google, you'll be able to find something like this. And you can punch in your income and it'll spit out the bottom exactly what your tax will be, assuming no other deductions and things of that nature. And this is the current rules. This is the current sliding tax rate that we're in. 18,200, you pay 0 tax. 18,000 to 45,000, you pay 19 cents to the dollar. But you do have this little thing here once you're eligible. And yes, I did say whether you're eligible to pay tax. You get the extra 2% Medicare surcharge, which takes that to 21. 45 to 120, you're 32%. So you might say, Andy, but you said 25%. Yes, it's your average tax, right? So if you add up the whole amount of tax and then you divide that by your total taxable income, then if you're 120, you're not 34.5, you're only paying 34.5% on the amounts between 45,000 and 120, right? But because you're paying none from 0 to 18,000 and only 21% between 18,000 and 45, if you add up all the tax that you'd pay, the total amount is 26% on average. So check it out. Go to these resources online. They're super simple to find. Or you can just ask us. We'll whack a link in the chat. But this is how we play the game. Now, if you are above, say, 180, or if you want to keep the lowest amount of tax and you want to keep that at 120, the next level that you can access tax deductions is within your super. Now, it's a little bit late for you. You guys should have been doing this last year, but now you can start planning for the year ahead. And you can put additional contributions up to $27,500 for last year as a personal deductible contribution, and you can claim a tax deduction for those additional contributions. Right, you'll have probably put some in there anyway, but last year it was up to $27,500. Who can tell me what it is this year? For those of you who want to start tax planning, and so I'll ask two questions. First one is, what is the deductible amount for contributions into super this year moving forward? And when's the best time to start tax planning? For those of you who don't know, I'm a bit of a Hawthorn fan, and they're back up and about, which is amazing. There we go. Yep, Luke, 100%. Diana, 100%. We've got 30,000 is the new concessional contribution. So it was 27,500 last year. It's now up to 30K per person. Now, if you have the ability to salary sacrifice, if you have the ability to manipulate your income, which most of us do to a certain extent, right? To a certain extent, then last year you could have accessed 207,500 worth of total income. Now that could be from investment properties. That could be from, well, that's a bit hard to read there, isn't it? Let me change the color on that and make it a little bit bigger. 207,500. Could have paid 207,500 per person and paid under 30% tax. Right? Pretty good. That's just what a little bit of pre-planning can do. More money in your pocket, more money for your lifetime, rather than wasting it immediately on infrastructure projects that never get off the ground. So the question then becomes, right? Because on the journey of property investing, on the journey of wealth accumulation, on the journey of just being an investor in the market, business owner, whatever it is, if we want to minimize our tax, we need to strategically think long-term game. And we need to also think, well, how do we minimize the tax? And this is the first step. So we've gone personal. Yep, we've figured that out. We didn't want to have any more than 180 because that was 30% tax. Now you may choose to want to pay more than 30% tax. Typically in my world, the only reason I want to pay more than 30% tax is if I need to get loans and things of that nature and I need more accessible income. I prefer to minimize it wherever I can. I'd utilize my super. Now, I can't touch that, right? So you've got to chat with your advisory team and make sure what's right for you. But, this is a map of the world of how you could. I'm not saying that you should, but it's a way that you can start to think about the game and then, chat with your advisors as to what the right move is. This is just a game of sorting for 30. So personal, in my world, I haven't put any more than 180,000. So that's come to me in my personal world. Then I've topped up my super. And as a result, I've put in 207,500 and my average tax rate is below 30%. I reckon that's pretty good. And for me, that's what I did this year. So I'm winning. Or last year, rather. Jeepers, how quickly the years go. So this brings me across to what the next big thing is. And I'm pretty excited about it because, when you don't have people being proactive in the government, you need to figure out other ways of being able to, and people call it cheat the system. It's not. It's just literally play the system based on the rules that the system's designed on. But before I get into the big thing that we're looking at focusing on, would you like me to share with you just the difference between last year and this year? Because there's a bit of a difference between the tax rates. Some of you might know that we had the 3-stage tax cut system that was coming in. I'll take you down and show you anyway, just to give you a little bit of a history lesson as to what brought us to here today, right? So during the period of times of COVID, or coming out of COVID, the government introduced the 3-stage tax cuts. I'm sorry, that's a little bit hard to read there, but that's stage 1 there, that's stage 2, that's stage 3. Now, these were proposed, and of course they were changed, because what does the government like to do? Change things. So that was the change more recently. So back in 2019/20, who remembers those days? Feel like it was just a pup. We were tax-free, and look at that. The tax-free rate has not changed. It is 18,200. Hasn't changed. 18,200 since 2019/20. Might have even been a lot longer earlier. My suggestion would be potentially allow this stuff to work with inflation a little bit. I think it's fair. If you're going to tax 30% of my money up to 180,000 and then inflation kicks in because you haven't managed the economy well enough and inflation goes up by 5%, in my world, I reckon it'd be nice if the tax-free threshold went up by inflation, or everything went up by inflation, so that it was an even playing field, right? So we're earning the same amount and getting to buy the same amount of stuff with it. Not anymore, because that would be inflationary. I'm not asking for any more, just asking not for less, if that makes sense. So anyway, one of the things that I'm waxing lyrical about, I reckon they should change that. But anyway, that's just my opinion. So, team, the tax cuts were coming through. Stage 3 was meant to be tax-free from 0 to 180. Then it was meant to be 19% from 18,201 to 45,000. Then it was meant to be 30% on 45,000 to 200,000. And then it was meant to be 45 over 200,000. So that didn't make it through. They changed it. So where are we sitting now? We're sitting at tax-free from 0 to 18,200. We've got a 16% from 18,201 to 45,000. Then we've got 30 from 45,000 to 135,000. And then 37% from 135 to 190. And then it's top marginal over there. So that's where the world has been. That's where the tax rates are now. So one of the things that we're looking at now, and hopefully we'll bring some ideas and thoughts in and around it. We've seen a lot of other professionals start to look at the same sorts of things and putting out white papers and various different ideas as to, well, if the tax rates don't continue to rise, right, with inflation, which means all other things being equal, and what does it effectively mean? If we've got $180,000 that we can earn before we're top marginal tax rate, and then the costs of goods go up by 10% over the course of a year, things become 10% more expensive. You can, in theory, buy 10% less, right? But the government will still get their slice of the pie. So if it doesn't continue to go up with inflation, then the costs of lifestyle is effectively creeping up. And so are the investment returns that you're potentially earning. So one of the things that we're looking at and we're putting our heads to and trying to figure out, well, is this the right thing to be doing? And should we be focused on this? Because we want to make sure that we're looking forward and thinking how to run things into the future. But we believe that investment companies are something that is going to get a lot more attention in the media, a lot more attention from advisors, accountants, those sorts of people. Because this may be a way that you can start to keep your tax rate on an average of 30% over time for your investments. Now, there's a lot of positives and negatives to this, and you need to chat with your accountants and your financial advisor about these types of things because it starts to get quite complex. And there are specific rules that apply because on average or in the normal sort of way of things, you can access up to a 50% discount on capital gains if you own things in your personal name over 12 months. There are some terms and conditions that apply to that. But in a company, you typically don't get that, and you get taxed on capital gains from $1. But it's at a 30% average tax rate right across the board unless you trade it. So some of the things that we're looking at is if you're a top marginal investor and you think that you'll be top marginal for a lifetime because of the way that you're investing, we think that potentially starting to explore investment companies and isolating that rate at 30% could be a way of being able to really make sure that you're minimizing what you're paying to the government and ultimately keeping more of what you make. So when you're sitting down with your accountant, your advisors over this year, feel free to use this matrix and just draw a triangle and think, well, how much are we paying personally, right? And then how much have we contributed to super? Now, if you're starting to maximize both of those within the tax rates that apply right now, then you can start to look at structures, right? And you might even start to ask them, well, what about investment companies? Is that relevant for me? Is that something that I should be looking at doing? Because quite frankly, if we don't think that they're going to start to change the rates and give you a little bit more flexibility and more freedom moving forward, then they're keeping more of what you make. And my job in my world with my clients is to try and teach them how to keep more of what they make. And ultimately, the question starts with, personally, how much am I paying? Have I got enough into super, and is it the right amount into super? And then how much should I be putting into my structures? And should I start to use structures in order to invest, minimize tax into the future? These are the sorts of questions that I'd be asking your professionals at this tax time. And ultimately, the goal is to keep more of what you make, make sure that you're happy, and make sure that you've got enough in order to be able to take care of those first couple of layers of Maslow's hierarchy at the bare minimum, over your lifetime. So, team, that's it for this morning. I'll be back next week, Monday, Tuesday, and Thursday, to have a conversation with you all. But hopefully you're set for a cracking week. Wishing Witten all well for his climbing activities. But from me to you, team, have an amazing Tuesday, cold or warm, wherever you are. It's been great hanging out with you this morning, and look forward to chatting with you about a few other little ideas that we've been percolating early next week, Monday, Tuesday, Thursday. Team, I'll catch you then. But for now, we'll sign off. Have a wonderful week from me to you, and we'll see you all real soon. See you, team.
Episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.